All right. Today on the Pay Dirt podcast, we've got Drew Clark, President, CEO, and Director of Summit Royalties. Drew has spent more than a decade building royalty companies and putting together deals which tally well over $300 million. Before launching Summit, he was the first employee and vice president of corporate development at Metallo Royalty, where he helped grow that portfolio from just 18 royalties to more than 100. He's also worked in investment banking, equity research, and has held senior corporate development roles at companies that were ultimately acquired, Alamos Gold and Sandstorm Gold. So he knows the business, and he knows it from just about every angle. Analyst, banker, deal maker, and now CEO, Drew Clark. Welcome to the show.
Thanks. That was a great intro.
Happy to have you today. How are you doing on your side of things?
Things are great. It's a buoyant gold market for a change, and look, I think people were ready to hit the pause button after July, but I think people might have to get back to work. So we're seeing a little bit of buying, volume picking up in the stocks, not just Summit, of course, other companies that I follow. So it's I think we're into a bit of a constructive market here.
Yeah, for those of you listening, a couple days down the road from now, we're recording on Wednesday, August 5. And, gold's kind of coming up off the mat from around 4,000. Last I checked about a half hour ago, it was around 4,200 USD. So that's the climate of this conversation. Drew, the one question I wanted to kind of hit with you first as I'm going through your portfolio, Gold Advisor, you're one of the newer participants in Gold Advisor, one of the newer additions to our portfolio. So it's only recently that I was writing up, the overview on your company. But in a matter of very short time, you've just completed a revolving credit, as well as completed your acquisition of Star Royalties. Walk me through some of that.
So, I mean, we can work backwards. We'll start with the first one you mentioned was the revolving credit facility. For a company and I guess the importance of it, for a company that's less than 9 months listed, we're very flattered to get the attention of one of the tier one banks in Canada. And it's a natural step for us to build our business in a non-dilutive way, but more importantly, it lowers our cost of capital. So the facility is $25 million US right away. And then there's an accordion with the same terms for an additional 25 million. And that additional 25 million is at the same terms, but it comes with sort of a blessing from the bank that they like our uses of what we're using it for. And we're really excited about it because I'd say the number one reason is that lower cost of capital. The cost of issuing equity versus interest at sort of a 6 to mid 7s interest rate is a huge gap. And then the validation from the really big institutions showing that a large tier one bank is also backing us is really what we're excited about. So we're going to get to work and try to deploy that sometime as soon as we get deal to do. And then the other one you touched on was Star. Star was the second royalty company we've acquired in the last 9 months. And it was an important step for us to get larger. I think without having Star, we may not have been able to get that facility. I haven't been explicitly told that, but that's my personal belief. And it brings in a very exciting development asset called Copperstone that a company called Mining Americas is currently constructing. I'd like to preface that it used to be called Minera Alamos. People are still learning that they changed their name, but there's a lot of growth within that asset and the rest of the portfolio. So those are kind of just the latest steps in us building out our portfolio that has really just been built over the last 15 months.
Yeah, you've moved quickly. Just going back to what you were saying there, when you partnered with Star, that helped you get your revolving credit. Clout begets more clout, as they say, or as I'm saying currently, whether that's a phrase or not. But I would imagine that having that revolving credit allows you to move fast on new opportunities that pop up, and you can action on them quickly without having to do that raise and go through the financing side.
And look, we've bid on portfolios and a bunch of assets in the past where there would be an equity component with it or other sources of debt. I think being able to show that it's available now is going to make that cadence of being able to close quickly or potentially getting more calls will be there. So I think that availability will speak to bigger and better opportunities is what we're sort of indicating to the market, and that's our hope, obviously.
You've completed a lot of these deals very quickly, as you're saying. You've been trading for 9 months. You've already got 48 royalties in your portfolio, and you seem to be adding more. What does a deal have to offer to to make you want to consider it and consider it deeply, and then to pull the trigger and spend the funds on it?
So I get this question often, and I'd say the first sort of lens you have to look through, and this is sort of how we think about things, but I think it's instructive as to how we look at doing things, is the price you're paying. And let's use the two deals this year as an example of that. We paid, I don't want to say close to full price, but a very healthy multiple for Star because it had a project that was going into development and there's assurances of it was going. And the reason I highlight this is the price you're paying, the price for entry is a big factor in how we consider things. The other deal we did this year, we bought from Prospector a 1% royalty on one of Newmont's assets in BC. It's, call it 20 kilometers away from the Red Chris mine. We don't have a clear start date for that one, but we also paid 5 million Canadian for it. And that's that sort of lens. So if we paid a full turn of NAV or close to a full turn of NAV on that asset, that would change it. So what we're looking for, and I hope that's instructive, just to sort of help understand that price lens is a big thing that we consider, is what we're looking for, particularly if we're using debt, is something that's cash flowing today, which is easy to understand. It's a cash on cash yield, or something with a defined timeline to production. And I can't speak to deals that we're looking at currently, but I'll use current parts of the portfolio as instructive. If there was another asset like Copperstone that's in construction and being run by a competent operator, we would certainly look to acquire a royalty on that. If there was another royalty on Pittingui, one of our other development assets that's being put in development by Jaguar this year, we would certainly look to add to that. So I'd say there's no hard and fast rule. 2 to 3 years out from production with a real timeline is probably the length that we go to use the debt. But we are also looking at portfolios. We're looking at being part of acquisition vehicles for some of these non-core assets that large companies are selling. So we're always looking for unique angles to just buy assets and accretive valuation.
I would assume part of that too is knowing which deals to avoid and which deals to walk away from. Do you have any sort of hard and fast rules about things you certainly wouldn't touch?
So this goes back to the price conversation, which is a factor. But we have had, I've got lots of friends in the industry as your networks grow. And sometimes I literally say to them, you don't want our capital, it'll be expensive. The only way I can get over the line there. But we're not looking for assets that are in, I'll just make up a make-believe company, $50 million market cap, needs to raise $500 million, doesn't have a technical team, stuff of that nature. You're hoping it gets built this cycle. And what sort of plagues some of the nascent royalty stage companies such as ourselves is they've been able to buy that long-term optionality and development fairly easily, not easily, but it's easier to acquire that stuff. And then you convince the market it may get built in the next 5 years. We're really trying to avoid that. We hope it gets built sort of aspect of building the portfolio. But at the same time, at the right price, buying that optionality, and we mentioned the Newmont asset earlier, buying that optionality is something that can really pay dividends down the road. But when we typically buy these no start date optionality plays, we like to pay very little for them. I mean, you like to pay very little for anything you're acquiring in life, but that's where the rest of the portfolio kicks in. And we'll probably touch on 43 or 44 royalties, or sorry, we will not touch on 43 or 44 royalties that we have under contract currently at the company. So that optionality is important as well.
Yeah, I could see what you're saying there. And as you're talking, I'm kind of wondering, as you're sort of kicking the tires on various assets as well, is there a big discrepancy in what you're seeing in terms of what those individual mines are paying for their all-in sustainability costs? Does that factor in at all? If they've got high production costs or issues like in the sense of there's a big deposit, but it's hard to get out of the ground. These all probably play in there as well.
Well, and ultimately, I think the royalty companies are sometimes painted with a broad brush. You don't care about the asset if it makes money. I would argue, contrary to that, companies that mines that make money get expanded. Mines that get money get explored. So the profitability of the mine is important, as is the competency of the operator. So when we look at these things, if it is a higher cost mine, that would impact sort of the price you pay for admittance on it for sure. So we do consider that. But I mean, at this stage of the game, I mean, you're looking at $4,200 gold. If you have assets in your portfolio that are still struggling to make money, you may not have made the right investment. We also think about what does this look like at $3,000 gold, and in terms of the impact of the business. Will we lose any of our mines? And we're quite confident that we won't. But yeah, no, cash costs are important.
Speaking of cash, when you combine with Star, you highlighted a roughly US $2 million in annual cost savings. Is where does that savings come from? Is it from just not having so many different layers of red tape to go through? Is it that you're able to streamline to different assets that maybe you wouldn't have had a chance to purchase in the first place? Like, where do you get that number?
It's really just G&A savings. We were a much leaner team than Star was.
Hmm.
And as much as there's upfront costs, you're going to pay change of control when you acquire a company. We think the ongoing businesses will be run at a much lower overhead. So most of that comes from overhead savings. But then there is a overlay on top of that when you don't have to duplicate legal costs, listing costs, um, AGM, stuff of that nature. So that's where that's substantiated from. I've had that question a couple of times, and I can back out the math, but it's comfortably right around that number.
Yeah, I mean, I'm not calling you out on the math. I'm more curious about how you hit that number, and then I guess I should have followed up with what do you intend to do with that excess savings? Does that get thrown back into the next asset? Does it get thrown into the cash just in case you want to, have a little bit of a fallback number in the bank accounts, or paying back some of that revolving credit?
So the revolving credit facility we haven't drawn on. So right now we pay standby charge on that of call it 200 grand a year. So that does add to the overhead. But what do we do with that savings? I mean, scale matters in this space, but ultimately that just goes under the balance sheet. The cash balance comes up. So either you own shares of Summit and there's 2 cents or 5 cents or 10 cents of cash. I mean, hopefully that number goes higher and you can back it out, or we funnel that into more deals,
Right.
as you mentioned.
More deals, more money. The forecast in your last presentation for June highlights a 47% increase in gold equivalent ounces growth over the next 3 years. Is that based on just as things are now, or is there a number of catalysts that need to go right? What do you foresee as being the number one driver of maintaining that you hit that number?
So, and great question because what's in that number is important. So when we back out, there's four assets that are currently operating in our company. Some of those assets are actually expanding as we speak. That would be Madsen. Some of them have expanded. That in the case of Bombori, that's our silver stream that has expanded this year. So some of that is just organic operating assets getting bigger. But a bulk of that growth comes from two assets that are being run by very big companies. I mentioned them earlier. One of them is the Copperstone asset that's Mining Americas Inc. It's fully funded, it's fully permitted, and currently in construction. And it's being run by a company that runs a nearby gold mine in the state next door in Nevada. So we're very happy with how they're progressing things and the operator that we have there. And then the other growth aspect comes from another asset that's going into development this year with starting production next year, and that's Pittingui, and that's being run by Jaguar. So I guess, I don't want to go through the list of all these assets. I mean, I didn't touch on Zancudo. Zancudo is installing a mill this year. That'll also raise some of the growth, but this is very low risk growth.
Mhm.
So all of this is based, to answer your question, all of this is based on publicly disclosed reserves, mine plan start dates from our operators. So there's no, we hope this happens next year. We hope this happens 2 years from now. I'm not suggesting there isn't stretch targets and things can't get better. We actually see a lot of opportunity for these things to get bigger, but this is what we know today and what's being disclosed by the operators of where we hold the royalty or stream.
I have a follow-up question on that, but I also have a follow-up question on Pittingui and Copperstone. Are there any specific milestones that we should be watching for on those two particular mines in general, like to make sure that everything's sort of going the way you want it to go?
Well, I mean, there's milestones from perspective of them delivering on what they're going to say, and sometimes no news is good news. So in the case of Pittingui, since we first started talking to IM Gold in end of 2024, we closed in the fall of 2025. The timeline for Pittingui has not shifted. So them just starting construction there is going to be great. And I'm not suggesting they're not going to do anything to sort of enhance the value of that royalty, but we're very confident in their ability to deliver. They've been there for 20 years. In the case of Copperstone, I think an updated timeline as to the deliverables and the commissioning of the mine will be delivered to the market, in the next couple months. But they're also drilling out an open pit target there. They're planning on releasing this quarter. So there's some development milestones, which is just them breaking ground in the case of Pittingui or the updated timeline from Copperstone. But then we also see upside on the assets themselves. So yeah, just keep checking those boxes is kind of the way we look at it when we talk to our guys that
Yeah.
are operating these mines.
Well, that goes to my second question that sort of fell into what you were saying earlier. How do you manage any of the setbacks that you might encounter? Obviously, you don't have any control over what gets constructed and when, how much is spent on it. Even something as much as like bad weather. So how do you manage those setbacks, and how do you convey? I'm assuming frustrations to shareholders, but also how do you like make it so those of us holding Summit Royalty aren't freaking out because one royalty kind of fell offline for a bit.
Well, look, I'll use one from the current portfolio with Madsen. Madsen declared commercial production in January. We always communicated to shareholders that we viewed this as a ramp up year, and this is consistent with their messaging. But you have to inherently take the timeline and the disclosure from your operators. I'm not going to disagree with the guys that are online, but I think investors and then just some of the people that own companies like Summit, because it's more of a generalist product, maybe have less experience in space. Mining it's like renovating a house. Sometimes it comes in a little late, sometimes it comes in over budget. Like these things happen, and mining is extremely complicated. So I would like to sort of suggest that we try to be very transparent with our shareholders and anyone interested in Summit that look, we know where these assets are going. If one of these assets gets delayed by a quarter, it's not going to hit our share price that hard. And the fact that they're being developed and coming online is what we're conveying to people. But the frustration is, we can bang our heads against the wall, but we're ultimately passengers on these things. We are a passive investor on these
Yeah,
assets, and if they don't perform, we don't get paid.
yeah. So as you were saying too, I was thinking, you mentioned Pitangi. Am I saying that right? I always pronounce it as Pitangi in my head.
I'm not sure. My Portuguese is not the best.
So Pitangi and Copperstone, but you've got to be pretty excited too with what's happening with Banyan at Ormac, right?
Absolutely, yeah. And I'm glad you brought that up. The Banyan team has done a phenomenal job, and it's incredible. If I look back, call it 18, 24 months ago when I first started talking to the Eagle guys, the market cap on the company is 60, 70. Today it's over half a billion. They went from one or two rigs, or now they're doing four or five. So just the cadence of drill results and what's coming out of that has been really exciting. The resource where we've got full coverage on airstrip is up over 50% this year, and they're putting out a PEA. I think it's next quarter. They originally it indicated maybe it'd be Q3, but I think it's Q4,
Hmm.
and they're calling for 300,000 ounces of annual production out of it. And I think that's a phenomenal part of our growth. And going back to our earlier conversation, we don't have Banyan starting in our numbers, but we think that has tremendous value for us.
Right. So it's a sort of a well, you obviously want it to come online as soon as possible, but right now it's not being baked into your numbers at all.
No, it's not. And I think with timelines, as this gets de-risked, I think we may get more credit for it in the markets when I talk to institutions. But I'm going to get really nerdy on the royalty side here. Let's just suggest it's trading at 0 or 0.1 times its net asset value in our company today. As the PEA comes out, as they start doing development work, as they start talking about permitting, that point one goes to a point two to a point three, and ultimately goes to one as these things go into production. So you've got the time value as these things get closer to production, they become worth more money. But the actual multiple the market will pay for it is going to expand in time. So I think, this time next year, we'll be talking about what the impact of that asset when it inevitably comes on could be for us. So it's not just that crystallizing moment of when the cash flow comes. It's also when the market starts to give it credit for it's actually going to be built. And we can use the perfect parts of the portfolio today. Copperstone. A year ago, the Star guys would have gotten less credit for it. Now it's funded, permitted, and in construction. That's the kind of multiple expansion that you can see along the way as well. So we're very excited about Banyan.
I can see why. I'm supposed to be going up there in a month.
Oh,
Still
excellent.
working out the details right now. But my next question is sort of revolving around in your presentation works, let's say, or your the downloadable docs. You refer to yourselves as being discounted to your royalty peers. Now, based on
Mhm.
what you were just saying, some of that answer was in there as well, with like things like Banyan not being totally baked into your numbers yet. Can you go any deeper as to why you might say you're meaningfully undervalued compared to the other royalty streamers out there?
Well, look, and appreciate the question. The fact of the matter is, I mean, Haywood has us trading at 0.6 times our net asset value. And most of our peers are in the 1 to 1.2 times NAV. So that's, verified third party numbers. So these aren't our numbers. That's what the market thinks of us. So we think closing that gap comes with time, and that's sort of like we're seeing the volume pick up. We're seeing more research come online. So we're doing things on our end and marketing as much as we can to close that gap. The other part of this sort of value proposition that I get really, really excited about rather is um, when Copperstone, Pittingy, and Madsen and all these assets that have clear defined timelines to get into full ramp, these assets will generate well over 4,000 gold equivalent ounces. So at today's prices, that's well over 16 million. We all of our peers are trading at 14, 15. Some of them are trading closer to 30 times their revenue. If we just argue for 15 times revenue, which is kind of close to, actually there's one company below it, but 15 times revenue at 15, this is a close to 225 to 250 million dollar business on a cash flow basis. Call that 330 million Canadian. We have 100 million shares out. So you can argue for a $3 share price, still trading at a discount on a cash flow basis. So I think the revenue multiples that are being afforded to our company and the potential that's there, and then if you look at just the net asset value, which is the value within the company, there's a really good value proposition. And the last thing I always highlight when I talk about the valuation is 2/3 of our net asset value. So 2/3 of the value of our company will be in production this time next year, or at the very least be commissioning. So this is not I hope it gets built in the next 5, 6, 7 years. This is like very defensible and very easy to measure net asset value, attributable net asset value to the company.
2/3 in the next year. I
Two
have to
thirds
repeat.
next year. Yeah. So right now about 30% of our portfolio is online. And then there's another, call it 33, 34%. Half of that's in construction and the other half is about to go to construction. So it's a very low risk um, proposition for investors coming in. And then that 40%, roughly, call it 35% that remains, that's dominated by Banyan, it's dominated by the Newmont asset, it's dominated by 40 royalties in Canada. There's a lot of optionality in that portfolio that I think is extremely discounted in the shares.
Yeah, clearly. But I had to repeat that number. So like within the next 12 months, 2/3 of your assets will be online, which is pretty good.
According to our operators,
If all goes well. Yeah, there's some things,
all
as we
goes
alluded to in the
well.
previous question, some things are out of your hands.
Yeah, and the analogy I use when I talk to people is that you do a renovation on your kitchen. You think we'll be in by Christmas? It's January. I'm not suggesting that's going to be the case on these assets. But yeah, Copperstone is planning on ramping up this time next year, and Pittingy, depending on when they get their installation license, which we're hoping is sometime this quarter, they could be producing gold. Definitely by the second half of 2027. And just seeing the activity, just seeing them sinking shafts, driving ramps, installing mills is like music to our ears. It just shows the progress and it's happening. So we're just very excited to see all these things come online. Yeah, but by the end of 2027, we'll have 6 assets online, and these things will ramp up not as quickly as the technical reports show. And you made an earlier question about big frustration. Every technical report has, 1 quarter to go to 100% capacity. We haven't seen that much in my career. But I think by 2028, yeah, this business will be doing, 1,000 gold equivalent ounces a quarter. And that's gonna drive a ton of revenue for us.
Yeah. Just sort of doing the math. 1,000 ounces a quarter times current gold prices. It's a good quarter.
And our G&A is low. We've got a modest office in Toronto. We fly economy.
Mhm.
It's our overhead's quite meager compared to our peers, and we want to keep it that way because one thing I haven't mentioned, management and directors own 12% of the company, so we're quite aligned on that.
That's in my questions. It's coming up, baby.
Okay.
Stay tuned. No, the,
Yeah.
the the question though, as you're saying this, I've always kind of thought about it and wondered about it. Like, if you're a CEO of a royalty company and you've got 48 companies, that are part of your basket of goods, how are they communicating with you? Like, you're obviously not getting updates from press releases. Are you having regular calls, touch points, that kind of stuff?
So two things. It just like people. Some people are much more up for forthcoming than others.
Mhm.
But then there's also in every royalty agreement is different. Some of them actually have information rights baked into it. So we have information rights with some of our assets. I actually don't like to disclose which ones those are because then people think I'm speaking about things that are non-public, and I'm trying to be very careful about what my
Understandable.
messaging is.
Mhm.
But for the most part, when you acquire a royalty on a company, there's a little bit of a, oh crap, like we should have bought it back, or maybe we would have liked to. But then they realize they're paying that royalty anyway, and now you're putting it in a group that I think markets well and markets often, and will kind of go out and do a little bit of marketing for you. So there's a bit of a symbiotic relationship that can be come out of it. But for the most part, we dig in with technical guys when we have the capacity. But for the most part, we are like this is a passive investment, right? Like we do not have any say in anything that's going on. So we sometimes learn just as the market does.
Huh. That's interesting. I would assume, there's a regular touch point. But as you were saying, some people are much more forthright with information. Other ones are kind of like, well, they'll find out when we tell them.
Yeah, when I'm ready, you'll find out. Yeah, and look, I'll speak to one of the ones that we recently closed on the Copperstone asset. We do have visitation rights, and it's got very good information rights. Um, but we don't get non-public information from them and vice versa. But the idea of going to Arizona when there's no one there and there was no construction versus now, I mean, we didn't see a point in going to site as well.
Hmm.
So you also want to go there when you can actually learn a bit.
Yeah, that's exactly true too. It's a wholly, totally different feeling once you've put your boots on the ground. Just kind of going through some of my own previous site visits with companies I was very familiar with on paper, and then you stand on the site and you look out and you say, all of this is part of their tract. It's you read the words 690 hectares or something, but when you're standing on it, you really get a feel for how grand it is. Uh,
Absolutely.
Earlier, you were talking about management owns 12% of shares.
Yes.
How does owning the shares, when management and the board owns that many, how does that affect what you're going to do next in terms of whether it's walking away, putting the money out for something new? Obviously, when you've got that much skin in the game, if you have to walk away from something, it stings a little bit more. But so, how does that play into your day to day?
Well, I think we think like shareholders, and there's alignment there right away. I mean, it's a tremendous amount of my net worth is tied up in this company. Just speaking to me myself personally, but I think that alignment is paramount and something people really care about. What it means from when we look at assets, it's quite simple. If the company's not worth more on the back of doing something, we don't do it.
Hmm.
But then there's all the other overarching thesis of we need to get larger to compete. And so you have to think about it, the strategic overlay of it, but it drives everything. Look, we don't make minimum wage at Summit, but my shares are far more important to me than my salary.
Hmm. Which makes total sense.
Hmm.
You caught me off on my next question because like we don't make minimum wage. The shares are more important to me, and I was kind of like I drew a blank there for a hot second, but
Yeah.
it makes total sense, right? The share valuation, what you're putting into the pot, yields the best flavor meal, right? Not worrying about the day to day little things. What am I missing here? Because I don't want to keep this going too long. Short and sweet is always the best play. What am I missing here? Like, what do you, CEO Summit Royalty, need us as shareholders and investors to know?
Just you need to understand that we are going to continue to grow this business accretively. And that's something that we all like to say, but that is something that is in our DNA. But what we can do aside from doing more fantastic deals, and we're going to endeavor to keep doing them, is also grow the volume. We've seen an uptick since we acquired Star. The volume's coming up. That's going to lower our cost of capital. The credit facility coming is going to lower our cost of capital. We're going to have more research coverage coming out from other investment banks here in Toronto. So we are pushing what we can at the corporate level while really managing the portfolio our best way. And then the last thing that I love to highlight, because I know most people understand the royalty model, our counterparties have raised over $400 million since we started this company. So these guys are in great positions to add drill rigs, sink shafts, hire better geologists, whatever the initiatives are at each thing. So we're really seeing a lot of activity on our assets that we're excited to see unfold. That look, every company's got upside, but we've got a lot of shots on goal, to use a Canadian term here.
Hey, Shots on goal is something that everybody can understand. So keep putting pucks on the net. Do you have any one last question that Jeff always asks, and he always asks me these questions when I do talk to him. Do I have any crazy stories? Do you have any crazy mining stories or any crazy stories in general to end this out on?
Yeah. There was a recent transaction with Franco-Nevada where they bought for over $1 billion an MPI on IM Gold. And the story about this I'm going to do a disservice to it, but it dates back to the 80s when a local baker lent money to the old mining company that went bankrupt. And if you think about 40 plus years later, a bakery netting over $1 billion from Franco Nevada on a failed investment that probably someone's dad made. I just love that story. And there's always the famous ones at Pierre Lassonde with Goldstrike, but I think the Trelon NPI is one that not a lot of us in the royalty companies talk about.
So, just to get this straight, a baker lent a mine X amount of dollars,
Yep,
and then
it went bankrupt.
in the bankruptcy, somehow the baker ended up with this much money as a result.
Yes, yeah,
It's a lot of rolls. Serious
yeah. It's
dough.
not bad. It's serious
Serious
though.
dough.
Yeah.
Keeping with the baker theme. That's it for me, Drew. I really thank you for coming onto the Pay Dirt podcast today. Really excited to be working with you going forward. I've been covering your story since we first started talking. What was that, back in June? So learning kind of with our shareholders and our readers as well, but also really getting to know the business. And there's a lot to be excited about here. So I had to ask you some of those deeper dive questions just to kind of get a feel for myself. Hopefully we were easy on you today.
No, it was a real pleasure, and I welcome the challenging questions. So it was a lot of fun.
Beautiful. Thanks, Drew.
Thanks again.